UPS is down 23% over the last 12 months, and in fact, just over the last week, it is down 7%. Now, with a company that is heading towards its 52-week low and a yield of 4.53%, is this now severely undervalued? And what are the reasons that this company is plummeting down nearly a quarter of its market cap just over the last 12 months? We're going to find out in today's episode. We're going to really understand why is UPS sputtering. Now, it was down just 8% yesterday. And one of the reasons we're going to discuss and take a look at is their investor day that they did release a lot of numbers. We're going to take a look at their guidance to understand what the market likes, what the market doesn't like. And as always, we're going to look at their dividend safety. We want to look at their financial metrics and really understand the valuation of this company. What is the intrinsic value that we've calculated? What is our acceptable buy price? And do Wall Street themselves see any upside to this company over the next year? So let's just remind ourselves of the historical performance of this company. Now, they are down 23% over the last year. Over the last 10 years, however, whilst they are up 54%, that is a pretty poor return on any investment, even when you factor in that that doesn't include those dividends reinvested. And we see their all-time highs at the beginning of 2022 at around $225. We do also note the forward PE does sit below 18. Now, in terms of why this essentially stock price has dropped quite significantly, not just over the last few days, but also over the last year, we can just take a note here. A few things we want to point out from this article released yesterday. Now, the main thing in here is their target for 2026. Forward guidance, what they're looking at is between 108 billion to 114. And as we're about to show, their latest revenue was 91 billion in 2023. So they do see some nice growth over the next few years. And ultimately, this is also higher than Wall Street's target for 2026 of 101 billion, with their estimations of that 108 to 114 range. Now, one of the issues that the market has seen and that essentially the company has spilled the beans is that they do expect the current quarter to be one of the toughest in 2024, and they are saying that their profits will be down a massive 40% year over year, which is very, very poor for any company. 40% is a lot. And one of the ways they are going to combat this is by cutting costs aggressively. And as they can see, the CEO himself, or herself in fact, has said not only was 2023 a difficult market that they've come off for, but 2024, as we can see, with the drop to their bottom line, is also expected to not be a very strong year, but they still do expect some growth in 2024 that we are going to take a look at. Now, to refresh ourselves in terms of how the company has performed essentially over the last few years, 74 billion on the top line in 2019. Now, remember, we want to see 3 to 7% growth year on year. In the more recent period, they reported a full year of 91 billion. So, whilst they did increase their top line over the last 5 years, what we can here note is that whilst it did increase all the way to 2022, we did see in the more recent year a 10% drop to their top line. So, something to bear in mind. Yes, there are that inconsistency of the more recent year, but over the longer term, it is moving in the right direction. Bottom line, however, not as great as the top line. 4.4 billion, it did increase to 2023 to 6.7, but we see a lot of inconsistencies year on year. We see it decrease to 2020 before increasing rapidly to 2021 before decreasing again for the next 2 years. So top line looking a little bit better. The majority of the last 5 years, they have been increasing their top line. Bottom line, very unpredictable. And as we noted from the CEO herself, she did say that 2024, they are expecting it to be another tough year similar to 2023, although there is expected to be growth in some parts of the business, which we will take a look at. In terms of the health of the company, well, total cash versus total debt, 5.7 billion in 2019. It has increased slightly to 6.1 billion, so they do hold a fair amount of cash and short-term investments. Comparing this numerically then to their total debt, what we can see here is it has decreased slightly from 28 billion to 26.7. So cash has increased slightly, total debt has decreased slightly, no real worries so far, but remember we do look at some important metrics shortly as well. Now, in terms of how they've performed versus the air freight and logistics industry, we have FedEx, very well known, as well as a few others that I'm sure you will have heard of. We can see over the last year, while UPS, one of the worst performing, down 19%. Remember, this is now if you include those dividends reinvested. We see that one of their main competitors, FedEx, in fact, the best performing. So quite a stark contrast between the two. Over the last 5 years, however, we do see FedEx performing fairly in line with the others. We see UPS, in fact, UPS performing in line with the others, 58% versus FedEx's 77%, and we can see the others coming in at a fairly similar rate. So it isn't great, in my opinion, 58% when you include dividends reinvested, but as always, past performance isn't necessarily going to occur again in the future. Now, in terms of the institutional ownership, it sits at 61%. We have $8 billion worth of sales by the institutions over the last 12 months. We have nearly double the amount of buying by these institutions over the same period. And we note in Q4, the more recent quarter, a lot more buying by these institutions. And in fact, 3 of the last 4 quarters, we note that. Q3, however, we do note the opposite. So in conclusion, institutions are buying a lot of shares of UPS more than they are selling, as well as that more recent Q4 of 2023. As always, we do like to take a look at insider buying as well as insider selling, and we've looked at both insider buys over the last 2 months for UPS. We can see the director in the 2nd of February did buy 1,400 shares, $200,000. Since then, the share price is up, and this is what we do consider to be a very bullish signal, as essentially insiders only buy for one reason: they believe the share price will rise, and we expect they have more information about the company than us. So whilst we do take this with a pinch of salt and we don't invest based on insiders buying, it is a positive to note for potential investors and in fact investors themselves. Now, before we do jump into the dividend safety as well as the financial metrics, just to let you know, they did have their UPS Investor Day. A few things we want to point out from this that we did find interesting and that we have sort of touched upon. In terms of their 2024 guidance, what we can see is between 92 to 94.5 billion. Remember, when we did take a look at their top line revenue, it was 91 billion in 2023. So they are expecting some growth, although very minimal, to that full year. What we can see is they expect the Q1 and Q2 to be down 1 to 2% year on year, but they are anticipating the next 2 quarters to be up 4 to 8%. So something just to consider, that they aren't expecting massive growth in FY24. As we can see here on the free cash flow, they are expecting to increase from 5.2 billion to 7 billion in 2026, which is a CAGR of around 10.5%. So that is nice to know. They are expecting an increase to this metric, which for me is very important as an investor. And finally, we want to touch upon, we did in fact discuss this earlier, but they are expecting that top line to increase 91 billion to around that 114, 108 level in 2026. Now, it does depend on what your estimations are, but we will factor this in when we do look at that model for the valuation to understand whether or not these are reasonable based on the current stock price right now. Dividend safety score then 69, it is safe. Market cap 123 billion, it is a mega cap company. And we can note the key metrics from the last recession. They maintained the dividend. They had average growth at negative 12% versus the S&P's negative 12%, and they returned negative 48% versus the S&P's negative 55%. Now, this was very shocking for me. I mean, for me as a potential investor, 0.6% increase in January this year. It does go to show that that is below that 4% inflation rate we advocate on the channel at a bare minimum that you want to be targeting. And what made it more disappointing was over the last 5 years and over the last 20 years, we did see double-digit increases. Now, they have been increasing those dividends for the last 14 years, whilst paying a dividend for the last 25 without a reduction. Now, in terms of dividend yield theory, as we can see here, it states the company is undervalued when that current yield sits below the 5-year average. Significant sign of undervaluation on the yield, 4.45 versus the 3.34, although we do note the forward PE is slightly higher than that 5-year average, but still slightly lower than the industrial sector PE of 20.2. Now, as always, very important, especially for this company, that we look at the free cash flow payout, not the earnings, which is susceptible to manipulation by management through accounting. One way that I point this out, 74% if you were to look solely at the earnings, massive red flag indicator if you were to look at the free cash flow of 110% for the last full year. That should be a red flag or a red alert going off in your head, which signals that management paid out more in dividends than they generated in free cash flow, which completely makes sense why they gave that dividend increase of below 1%. And look, 2024, we can expect something similar. So for me personally, I want to see below 60%, but again, remember this is, in my opinion, a red flag indicator. Let me know though your thoughts below if you agree or disagree. Now, in terms of the free cash flow per share, it has increased over the last 10 years, but a lot of inconsistency year on year. Do factor that into your margin of safety when we take a look. And 2024, do note they are expecting an increase to that. And we saw a nice CAGR of around 10 to 11% expected to 2026. Now, sales growth, as we mentioned, 3 to 7% is what we're targeting. Last full year, around 9% drop to the top line. Before that, wasn't too bad. So again, something to consider, but we do see that their top line, they're anticipating growth to around 118 billion in 2026. And we can see numerically going from around 60 billion to 90 in 2023. In terms of shares outstanding, we love it when companies essentially do share buybacks, giving you a larger proportion of ownership of the company, and they have done that from 924 million to 860, although we do note from some years like 2019 to 2021, they were essentially diluting your position by issuing shares, but the net position is share buybacks, which is nice to see. ROIC, now for me, I personally go for 10% or more to give me faith that management are able to effectively allocate their capital. What we can see here, it has decreased over the last 10 years. Now, whilst that may be a negative, for me, very positive that still, even after the decrease, 20% in 2023 is looking very solid. Now, margins is very important for this company given how volatile that bottom line has been. Above 12% is the preference for most companies. We can see it does straddle around that for the majority of the last 10 years. No real worries, but something to monitor. Pretty much the same to be said for the free cash flow margin around that 6% level. Finally, the net debt to EBITDA, very important, the earnings before the interest, tax, depreciation, amortization, as this signals the number of years it would take the company to pay off all of their debt net of cash on hand. And remember and factor in, it correlates to both dividend safety and balance sheet strength. In my opinion, whilst we want to see below 3, no real worries, because 2023 and 2024 expected around that 1.59 mark is nothing to worry about. So, a lot of things to consider, but as always, if you do enjoy these episodes, smash that like button. If value is being created, hit that subscribe and bell button so you are continually notified of these videos as they drop. So the first model that we're using in today's episode is Graham's valuation. Now we have the stock ticker symbol, the earnings per share, growth rate per analyst estimates, and the yield on AAA corporate bonds, giving us an intrinsic value of 122. Now we have our first signal of overvaluation, but do keep in mind we don't look at any of these models in isolation. We then use the second model, the multiples valuation model, companies in a similar sector and size, average P multiplied by the EPS of UPS to get an intrinsic value now showing undervaluation, and as we mentioned, we will conclude towards the end. We then get onto the dividend discount model with the yearly dividends, as we can see here, that very poor growth in 2023. However, on average, a nice 12.5%. Forward looking, we've gone 4%. This essentially gives us an intrinsic value above the market value, so we have our second signal of undervaluation. We then get to the DCF model with the free cash flow year on year. Forward looking, we've gone for around 10% over the next few years. With a discount rate, we get the present value of future free cash flows and terminal value. Now we can see with the cash and equivalents, add that together, subtract the debt, get to the equity value, divide by the shares outstanding, and we can see that intrinsic value is above the market value. So 3 out of the 4 models showing us an undervaluation signal. Now the intrinsic value here is just the average of these 4 models, and for today's episode we are getting a value of $159. Remember, you can grab a copy of this valuation model to get to the intrinsic value as well as the acceptable buy price of companies in your own portfolio or those on your watch list by clicking on that pinned comment below. As always, 10% margin of safety. For those that are new, we use that if we believe the company has a wide moat, strong financial metrics, and good forward-looking data. Now for UPS, we don't see it at a 10% MOS level just yet. We are waiting for around $144 or $143, which aren't really too far off. So you could say it has near enough a 10% MOS level, and you are looking at a yield of around 4.5, 4.6%, which for UPS historically has been a very good area to buy as an investor. In terms of Wall Street and their expectations, well, they're looking for around a target of $162 with upside of 11%. Now, bear in mind, this information will be slightly different now that we have the investor day that has gone by. They have updated their guidance, and also Wall Street have updated their upside and price target. As always, though, do let us know your thoughts in the comments below. Is UPS one now that you will trigger and buy? Is it one you're waiting on the watch list for a certain price? Or maybe for whatever reason, it isn't one you want to dabble into. As always, drop your comments below. If you enjoyed the episode, smash that like button. Don't forget to subscribe. And as always, we'll see you all on the next one.